All right. Hello, hello. This is Abel Pacheco, your host for the Five Talents podcast, How to Build Wealth Like the 1%. We are super excited today because we have Mr. Kirk Chisholm on the live stream with us, man. What's up, Kirk? How's it going, brother?
Hey, how's it going, Abel? Thanks for having me on your show.
Man, I appreciate you taking a few minutes and just sharing a little bit of knowledge and insight because you have 23 years of it. So I have a feeling we're going to learn a few things today, brother. I have a few.
Hope so.
Yeah. And if you don't know Kirk, absolutely need to connect and get in his world. He's the wealth manager and principal of Innovative Advisory Group. So he's literally the person that helps advise in people about wealth creation, wealth preservation. He's also the host of the Money Tree Investing podcast. So he gets to interview a lot of amazing guests across the span of different investing, different vehicles. And he's been advising wealthy individuals and families, family offices, et cetera, for the past 23 years. So he's one of those experts in risk management, self-directed IRAs. He can help with, the mindset of inflation, advanced tax planning, just really how to, build wealth and preserve it. So we're excited to hear more from him. And Kirk, in your own words for a minute, Kirk, what can you tell us who you are and what you do? Just, in your own words, brother.
Sure. Yeah. Thanks, Abel.
Mm-hmm.
So as Abel said, I'm a wealth manager at Innovative Advisory Group. We started the firm in 2008. I've been doing this for about 23 years and started our firm in 2008, primarily because I spent a lot of time on Wall Street in Wall Street wirehouse firms, Payne Weber before they were acquired by UBS, and Smith Barney before they were acquired as well. And I saw a lot of what goes on under the hood, and I saw the good and the bad, and I learned a lot. And I think one thing that I took away from it is that Wall Street's job is to sell you something, and that's fine if it's good, but if it's not good, they're still going to sell you something. So one of the things that we did when we started the firm, we wanted to provide advice in a fiduciary manner that is putting us on the same side of the table as the clients. I kind of look at myself as like, hey, I'm over here helping you make this good investment for you, right? That's my job, right? Because, we work with a lot of clients who they're either too busy, they're not knowledgeable, or they're uninterested in investing. And, think about it. You think Jeff Bezos is in there trading stocks every day? No, I'm not saying he's my client, but I'm sure he's not day trading stocks, right? He's got other things to do. And I'm sure he probably doesn't care very much other than the fact that he's got enough money. So, I think there are a lot of people out there who, like I said, are either uninterested, unable, or, there are people there that are smart and know what they're talking about. They just need somebody to help them, to guide them. So our role really is to help investors make good decisions. We as a firm have specialized in risk management, which is a big part of what we do. And the funny thing I learned at Wall Street is really nobody does risk management. Yes, it happens out there, but not in a way that I would deem as being sufficient, right? If, for example, if your firm went bankrupt in 2008 because you made some stupid decisions, you did not do proper risk management. A lot of financial firms did, right? And you'd think these are great firms that should never have that problem, but the problem is the risk management is not done in an aspect that is assuming that you could have these 2008 events. They assume that everything's normal and everything's gonna be okay, and if they're not, then everyone's SOL. And for you and I and everyone else listening to this, we're not going to be okay. If we're a Fortune 500 company that's the largest in our field, government's going to bail us out because that's what they do. They don't let big companies fail anymore. So they just take risks. That's what we call moral hazard. If you're the biggest financial company out there, the government's not going to let you fail. So they're going to bail you out. And that, which means you're going to take more risk, which means there's more high likelihood of you failing. So it's just it's this cycle that never ends. Because if you get big enough, the government will protect you. And that means you're okay to take risk. So we changed the formula a lot. We focus on risk management. We focus on ways to invest in many ways outside the market for clients.
Yeah. I love it. There's so many things here. Let me pause and kind of restate a couple, because if you are taking notes, you're trying to soak some of this stuff on, soak some of it in. One of the first things I heard was Wall Street, right? Wall Street gets paid to have you invest in this, vehicle, whatever it may be, right? Whichever one they deem is the right one. And if it's not a good one, they get paid anyways, right? And so just how to get your money from Wall Street to Main Street is one of the ways that we, deal with the commercial real estate investments, is that exactly. But man, you've seen it from the inside. So you kind of saw the, like you said, the kitchen behind the restaurant, serving it up. And I guess enough years of that, kind of switched directions a little bit. So that's one. I'd love to hear a little bit more about what you said was risk management. So for someone that's, layman, what does that mean? What does that mean? Hey, if you didn't do a good job, you didn't do enough risk management, maybe elaborate on that a little bit so that we can, learn and see from your eyes.
Okay. I'll try to touch on it at a high level, because I could go on for like 10 hours on risk management, but
sure,
at even a high level. So there's thing with risk management is most people don't understand risk. They don't understand the risk they're taking. They don't understand how to mitigate risks. So there's two frameworks I look at. The simple framework is the way to manage risk is identify all of the risks. Mm-hmm. And this means you have to be thorough. You have to identify all of the risks, even the stupid ones that you think will never happen. Identify all the risks, mitigate as many as possible, or transfer or find ways to mitigate as many risks as possible. And the third step is being comfortable with what's left over. Because no matter what you have, you can't mitigate them all. And you have to find an acceptable level of risk that you're willing to take. For example, if you invest in US Treasury, I think for my field, that's about the only thing I could say is a guarantee. That's the only time I can use the word guarantee is with the US Treasury, if done within certain parameters. Now, that shows you how confident our industry is in US Treasuries, right? And depending on the maturity, some of them are what they call the risk-free rate. And what that effectively means is there is no risk. And yes, technically there's risk, but Wall Street considers it no risk. So if there ever was risk to that, the whole system would implode because everybody considers it no risk. Sure. Now, the way I look at it is, yes, I acknowledge that the risks of investing in treasuries are infinitesimally small. Now, there are risks like inflation risk, which is a potential problem like what we're seeing right now, which actually is a reason you could lose money if you're not holding to maturity. But even if you do, you're losing time value of money. So there are risks in treasuries. However, you have to understand the risks. So seeing what they all are, right? Lay them all out. And you look at each one and you just say, all right, can I mitigate this? Oh, well, I can mitigate the risk of losing money in bonds by buying stocks, as an example. I'm not saying you do that, but that's historically what people have done as a way to mitigate some risk. And then you say, all right, well, I'm still left over with this fact that the US government could file for bankruptcy and not pay their debts. That's also a risk. That's an acceptable risk to me. Right?
It's comfort. That's the comfort level of this particular risk management approach, which makes perfect sense. Yeah.
Right. So it's like investing in real estate, right? You invest in real estate, you know what the risks are generally, but there's always some, right? Mm-hmm. Maybe the renter, you get a bad renter, maybe the title wasn't done right. That's a risk. Mm-hmm. But you buy title insurance, right? That's a way to mitigate that risk. Mm-hmm. So insurance companies, and I don't sell insurance, so don't take this as an insurance conversation, but insurance, the way I look at insurance is it's a good framework, because if you look at what the risks are, insurance mitigates a lot of risks, right? If you own a home, what's the risk of you owning a fire? Well, it's pretty close to zero, right? My parents had a house fire. If they didn't have fire insurance, they would have lost their house. Yeah. But because they did, they got a whole new house rebuilt for them. That's pretty cool, right? So it wasn't cool, but the fact that exists for so little money, that's a risk you can mitigate, and it's worth it. I would definitely buy fire insurance, even though the chances are I'll never need it, right? It's like buying life insurance on yourself, right? You're betting against yourself. But is it worth it for your family? Absolutely. Once again, I don't want to go down the insurance conversation, but I think about it this way. The insurance companies are the smart people in the room. They're putting their own money on the line and saying, all right, we have $1 billion and we're going to insure against these risks. Warren Buffett, he's one of the wealthiest people in this country, and he owns a property casualty insurer. I wonder how he made all that money, right?
I wonder how that happened. Yeah.
Right. So he has this multi-billion dollars, and he's saying, all right, we're going to look at the risks and rewards of insuring these people, and we're going to insure them, and we'll still make our 5% or whatever it is, right?
Yeah.
So they've characterized those risks. They know what the risks are, and then they put in a little margin for themselves. So it's a good way to, even if you don't buy insurance, which I feel like I'm talking way too much about insurance, but even if you don't use it, it's something that you can look at and say, all right, here's how they're pricing the risk. How should I think about it? Is it worth it? Right? Do you want to buy life insurance when you're 80? Probably not. Right? You want to buy it when you're 25? Well, it'd probably be pretty cheap, but I don't know if it makes sense. So you have to find that balance. So like treasuries, getting back to treasuries, is there a risk there? Yes. Do you want to insure against it? I guess that's up to you. You probably could find somebody to insure it, but I don't think it's worth it personally. So that's how I look, the main framework. There's a secondary framework here I want to touch on too, and then we can talk about it a little bit if you want. It's called TLC. So transparency, liquidity, and custody. So transparency is, what do you own? How do you own it? Do you own it directly? Do you own it in a vehicle? Do you own it in multiple layers? You know, like you talk about 2008 was layers upon layers upon layers. And I forget the quote in the movie. It's like, how much garbage can you stack in a sandwich? Like you're just gonna stack it all up and nobody even knows what's in there. Transparency is really important when it comes to risk management. You need to know what you own. You need to know how you own it, and what the risks are at the different levels, because there are additional risks, right? If you own things in entities. Liquidity. Real estate's a good example. Real estate has a liquidity problem. Now, you could look at that as a negative, or you could look at it as a positive. It's actually both, right? So liquidity is your investment liquid? I'll give you an example. In 2008, I had some clients who came to me and said, oh, we own these non-traded REITs. What can I do? I want to get out. Like, well, too late. You're stuck because everyone else wants out and nobody's buying. However, there were some marketplaces you could go to where somebody would buy them from you for like 30 cents on the dollar. Ooh. And but back then you didn't know if it was solvent, right? I don't know if you remember, Abel, but that was a tough time for everybody. So people were jumping out windows trying to get out of their real estate.
We bought our first pieces of property in 2008. This is
nice. Air high five. That's awesome.
We're going in.
Good for you, man. That's awesome. So so you look at that, but people were selling and there were people were buying. Mm-hmm. So liquidity was the problem. And of course, when there are crises, liquidity is always a problem.
Yeah.
So, but you think about it this way: if you need to sell when you can't sell, somebody will always buy it, but you're not going to get a great price.
Yes.
So the liquidity was in your favor if you're buying. It was against you if you're selling. So it's not a good or a bad thing. You just need to understand how it's going to play out. So right now, I would be a buyer in a liquidity crisis because it's going to happen at some point. And when it does, I want to be there with a pile of cash, just saying, hey, I'll give you 20, 30 cents on the dollar and I'll sit on it for 5 or 10 years and I'll make my money and I'll sell it later. So liquidity is a huge part of risk management and understanding how liquidity plays into what you're in. And I think most people don't understand that their investments aren't as liquid as they think, because like I said, they're liquid when you don't need to sell them. When you do, they're not. Think of stocks, right? Stocks go down 50%. Oh, they're liquid, but you probably don't want to sell them at that price.
Yeah.
So
no,
just something to understand. And then the last one is custody. And I'm going to bring this up because of our good old friend, Bernie Madoff, who everyone knows. And I think it was Bernie Sanford, or the other guy's name. It was something Stanford. But anyway, anytime there's a crisis, there's always these Ponzi schemes that get outed and people that kind of come to the surface. And the problem with custody is if you don't know who's custodying your assets, you might not have an asset. Bernie Madoff's a good example. He was both advising and custodying the assets himself. And so he could dip his fingers in the till and nobody would know. He would doctor up the statements. Nobody would know. So I'm not saying this happens a lot, but it is something you need to be mindful of because it does happen.
Yeah.
It's happened countless times over the years, and sometimes it's not always transparent, right? Like Enron or WorldCom or some of these corporate events where this happened. But you need to understand where it's being custodied and how solvent's in it. I'll give you one good example here. In 2015, I think it was 13, I don't know. MF Global was one of the larger futures brokers, and I actually had an account there. And I had a moderate sum, like minimum amount there just to play around the futures market if I saw the need. I wasn't really using it, but it was there just in case I wanted to buy futures. So it's there, and I'm sitting at a conference one day. I'm watching TV. I think it was CNBC. And there's our good old friend. I forget who it was. John, I forget the name, but anyway, he basically torpedoed MF Global, and he basically was up there talking, oh, everything's fine. I'm watching the stock prices going down as he's talking. Yeah. And I was hearing people talk about it. I'm like, this sounds like this is not going to be here, in a week. So I wired my funds out. 3 days later, they froze all the company's assets. And it took them, I don't know, I think 9 months to liquidate it and send people their cash. But I only had cash. I didn't even have futures. If you had futures, it was harder, but I just had cash. I wasn't taking any chances, and I'm glad I got the wire out. And it was hard to do, but the point is the custody was in jeopardy. I probably would have gotten my money back, but you never know. I mean, the FDIC is there to protect people from banks going under. The SIPC is there to protect brokers from going under. But when they do, and sometimes they do, you have to be aware of. So let's just say this. Let's say you have $100,000 in a bank and they go belly up. You're guaranteed by the FDIC to get your money back. Mm-hmm. But what if it takes them 5 years to give it to you? Yeah. There's no guarantee they're giving it to you tomorrow. They're just saying you're going to get it. So if you look at 2008, 9, and 10, the FDIC was understaffed. It took them a long time to go through these banks that were effectively insolvent.
Wow. I didn't think about timing to the whole event. I never thought about timing to FDIC, right?
It's like three-dimensional chess, right? You think you're playing in 2 dimensions, like, oh, I'm going to get my money back. It's like, well, there's that 3rd dimension of how long it's going to take. Yeah. So it's things like that you don't think about until they happen. And you're like, oh, wow, that would have been rough.
Yeah. So Kirk, to go to get all this is to pause, right? All this is just the mindset that I'm thinking about. I appreciate all of the different dimensions that you're talking in, because we talk a lot about commercial real estate, a lot about investing and the risk management, where you're identifying all the risk, mitigating as many as possible, and then just being comfortable with what's left. That's ultimately, like, a lot of investors that I speak with are afraid to make that next move. They're afraid to take action. They are sitting on capital but can't move forward. And I would venture to say is like look at some time test proven models of risk management, because you're trying to identify all the risks. You're trying to figure out where all the gotchas are, and then see how, playing chess here, trying to figure out how I mitigated and reduced my risk. But then ultimately there's some underlying remaining portion that you have to be comfortable with. And that's the difference between 2% return, 3% return, or a 15 or 16% return. Right. So I just even hearing it, and I like the, FDIC part, because if we take a lot of trust and confidence in, oh, this is the system. So we're literally banking on the fact that some portion is guaranteed, but we don't think about the liquidity portion, or the time and who's custody and how long it's going to take. And, they're all good mindsets, man. All good mindsets.
Well, it kind of brings up a point I want to kind of interject here is that you mentioned, we talked about liquidity. Anytime there's a crisis, it can be a crisis of liquidity, or it could be a crisis of solvency.
Okay. Yeah.
And I think people need to understand the difference between the two, right? Mm-hmm. So liquidity is, right, we're talking about real estate. There's no buyers. So there's no liquidity, right? But the real estate's fine. Mm-hmm. Right? People are paying their rents. You can pay the mortgage. It's not a solvency issue. It's a liquidity issue. Now, then there's crisis of solvency, right? Which, a good example is 2008. There were some solvency issues, right? Like we talked about the FDIC. They went through the banks, but slowly. Solvency was the problem. And when it comes to solvency, that's tough, right? If you're holding the bag on that one, you might as well just light your cash on fire because it's gone.
Yeah.
So, sometimes you get money back, but I think you just have to be aware of the asset you're in. So let's talk about real estate, right? Real estate, if you invest right, if you invest directly, not through this hedge fund or fund of funds sort of thing. If you just invest through like a syndication or direct or whatever, the solvency is either the investment itself or the fund that you're in. And unless there's leverage used, with the fund itself, not the asset, but the fund, then there shouldn't be solvency problems as long as as long as the cash flow is fine. Now, if everyone decides like COVID, let's take COVID, for example, that's a one-off event. Let's all hope.
Yes.
And, no one was going to their office. People weren't paying rent. It's a cash flow problem. I mean, let's hope that never happens again. But that was a huge problem for real estate investors. Yeah. And I can't think of any other type of situation where that would ever happen or even again, because it's, I think people are just done with that. But, that's something that people have to understand is that is part of the conversation is it solvent? Because if it's solvency issues, you might not get it back. If it's liquidity, it's just time. Like these non-traded REITs, just waited 5 years, you would have been fine. Yeah. You would have gotten your interest payments. You would have gotten your appreciation. You would have gotten everything you expected. It's like when they talk about the stock market, like Warren Buffett says this, anytime you make an investment, you should expect that the stock market's going to close tomorrow and it's not going to open for 10 years. Is this an investment you would make? If that's the case, then why are you looking at it day to day?
Yeah. There's a different paradigm right there than I think a lot of people are taking. And we, in our side, Kirk, we say a lot of cash flow. Like, well, cash flow, cash is king, real estate is queen, is how I heard it. But then also, like, we invest not for appreciation, but for cash flow. But realistically, like the mindset we tell investors today when they're investing, 50, 100K minimum, and some investors $1 million, $5 million, it is, hey, this amount is illiquid. It's invested in the real estate. It's invested in the asset. It's going to appreciate over time. There may be small distributions from here to then, but we can't pull the money out. It's in the bricks and sticks, and it's in the pavement and the parking lot, right? So it's like, this is it. I mean, and that's the mindset we have to kind of take. I didn't know that Warren Buffett had that mindset, or I'd never heard that quote from him before.
He's a wealth of wisdom. I think there's a lot of areas that if you look at some of the smarter investors, people would deem the smart investors, like Ray Dalio is another one. People love talking about Ray Dalio. He made some comment the other day, which is cash is trash, which is a catchy thing. But I was like, that's stupid. It's not trash. Cash is king. The problem is we're talking about different context. And the other problem is he can't say cash is trash. He can't say cash is king because everyone would sell and they'd stick in cash and the markets would implode. So he's got an obligation to the community to not go out and say certain things. Warren Buffett is another person who has an obligation. So you always have to take some of those things with a grain of salt. But I think most of the basic lessons are true, and Warren Buffett's known for taking his time to make investments. And when he makes them, he goes in big. And he'll sit there and hold on to him for like 20 years. And he's definitely made his share of mistakes. There's no question about that. But he's also one of the most successful investors of our time. And, I think he's a good example of somebody who generally for most of his career has lived his book. He's got this public persona, which is well crafted. And I don't want to rip on the old guy because it's not really the thing to do. But he has a well-crafted persona, and he's this old folksy guy from Omaha and all this. He's smart. Like he's always the smartest man in the room, but he comes off like this old folksy guy. But he's made some mistakes, and I think the good thing about that is we can learn from his mistakes too, because he will not talk about his mistakes for the most part, but you can learn from them. And because he's so public, you see them, and it's like, okay, that was interesting. He's been saying for decades that you should not invest in capital-intensive businesses. And what does he do? He invests in capital-intensive businesses and loses a lot of money. So, he invested in oil companies in the early 2000s and lost a ton of money. And, then he got out. I was like, okay, well, maybe because he wasn't following his own rules. I think his rules were fine, but he didn't follow them, which is always an issue, I think, with all of us as investors is
Yeah.
you need to have your own investing rules, and they should be based on your own investor psychology. And let me explain that for a minute, because we talk about this a lot in our show. Investor psychology is different. So yours, Abel, is different from mine, is different from Joe and Susie and all these other people listening to this podcast. Your investor psychology is customized to you. So you might be somebody who needs action. I'll say that in air quotes, action, right? You need to go to the casino. You need to be doing something. You can't just sit on your hands because it feels like you're not doing something. If you need action, then doing something like, day trading for a living might be a good profession. Or maybe flipping contracts, right? Buying real estate and flipping contracts. That might be a good one if you're into real estate, right? There's different modes of operation you can do. But if you're more of I want to buy and forget, I'll buy this good thing and I'll forget it for 20 years, then real estate's a great investment. You can buy some stocks if you do them right and hold on to them for 20 years. There's a lot of good investments you can make, but you just need to understand that about yourself. Because if you need action and you're trying to buy and hold, you're going to screw up all of your investments because you're not going to hold them long enough to get the realization of what they're doing. So most people try to mimic Warren Buffett because they're like, well, he's successful, I'm going to mimic Warren. No, don't do that. Learn from him. Learn from what works from him and then apply to what works for you. So if you're happy just sitting on the sidelines with a passive investment, then that should be your strategy. Figure out what works for you and do more of that. The most successful investors out there are people who know themselves. They know what they're good at and what they're not, and they do more of that. Business owners, like think of a business owner, you're running a business. If you're focused on one thing and you're in a niche and you own that niche and everyone knows your name, and then you go try to do, you're selling, you're selling widgets, and then all of a sudden you decide to go sell washing machines, which is totally unassociated with your widgets, then you're probably going to fail, right? Because it's not what your core competency is. The same thing applies to investing. It's just know yourself and invest with a style that works for you.
Yeah, the investing psychology. I like it because we're all different individuals. We've learned different things. We grew up in different places. We have different paradigms. Our parents taught us one thing and we learned something different, or this is how we saw, mom and dad do it or fail or win or lose, and vice versa. It gets shaped. And so if you don't know thyself, that's very hard to make good plays, because I like what you say, Kirk, is, man, if you're, going against yourself, you're going to mess up maybe your own investment when you should have just done nothing and you're an active person, individual. That's good, man. So let me ask a few questions here because we're getting close to the end of our time. And the questions that I have is really, in your wealth of experience, knowledge, the amount of different clients, people you've advised and served, I'm sure you can start to classify or categorize some of these different levels of investors. Maybe the, zero, or I have something to $1 million net worth, the 1 to $5-ish million net worth, and maybe these high or ultra high net worth individuals, maybe the top end of, this 1% of investors. Can you give us any of the learning lessons from what the top 1% is doing that, the next level investors aren't, and then vice versa all the way down? Like what do we see? And then what should we be doing to mimic them?
Okay. Yeah. So I'll say this up front. So there's kind of like 3 different categories. There's like the mass affluent, which is like $500,000 to about 2 million. There's a category about 2 to about 10 million. Sometimes you go up to 20 depending. And then there's that like 20 million plus. And, each one of those categories has different challenges associated with it. And, if I think about the mass affluent, it's people who work their tail off, whether they have a company or a job, they've done a good job of saving, and then they get close to retirement, and now they have to find a way to disengage from those habits. You go from spending a life of hard work and saving to taking it easy and spending is a really hard challenge to make. So for a lot of people, that's very difficult. And we do a lot of work with our clients in that area. Then you get to this other area, which is more like, the 2 to 10, 2 to 20 million area, and these are people who've had a good amount of success. They're kind of bordering, they're not wealthy enough where they can just like retire early. They probably could, but they're not quote unquote rich yet, but they are still kind of rich. So, they're in this kind of in-betweener stage. And, I think they have very different challenges. But when you get into the ultra high net worth, the 1% or the 1% of the 1%, the challenges are very different. And some of those challenges you might not think about. Most people think money is the challenge. They do have a problem with money still. It's just a different challenge than you and I might have. Not only that, but they have some additional challenges. Like one of them is loneliness. If you're worth $100 million, how many friends are you going to have? How many people can you relate to? Probably not many, right? If I'm worth $100 million, who around me is going to relate to me, right? It's just, I don't have quote unquote peers. So it's harder for those people to find friends or peers because either the peers are competitors or, they're probably not going to communicate all the details of their situation. So that they tend to be more closed off, and there's a lot of loneliness in that circle. Now, there's another aspect which is a challenge for that middle range, which is a lot of people tend to, and this actually applies 2 million and up, where when people get to like 2 million and up, they start to, the investments, they make good investments, but they tend to also have these kind of showing off investments, I like to call them, which is they're at the golf club and they're like, hey, I got into this cool fund. What are you doing? Right. It's more of like, FOMO, like, hey, I'm doing this weird, cool thing and I'm making lots of money. What are you doing? Like, are you doing it? Like, oh, I didn't get into that. I got to get into that. Like, it's this kind of FOMO sort of thing where they're just kind of comparing the size of their, whatever. And it just, to me, I get it, but that's kind of how they feel special, because otherwise the investments are boring. They don't, right? Investments should be boring, but who wants to talk about boring investments? So they come up with this flair and they have fun doing that. But I think if you really get up to the wealthy, the 1% or the 1% of the 1%, they live in a very different environment than the rest of us. Think about it this way. Every one of us have daily rituals that we go through, right? Take the kids to school. You got to go pay the bills. You got to go wash the car. You got to, you got to do laundry. You got to make the meals, like whatever, right? You do all these things every day. The wealthy don't have to do any of that. They don't ever have to work again. There was a good HBO documentary called Born to Be Rich. It was out, I think, about 20 years ago. Great documentary. It was done by one of the Johnson & Johnson kids. And the reason they did it was what they wanted to do was they wanted to explore wealth. They needed to explore on their own end this wealth that they had, and they needed to come to terms with it. Because imagine if you grow up with extreme wealth, you never have to work. Work is not just about making money. It's also about a sense of purpose. Like, what's the reason for you to get out of bed in the morning? I mean, that's actually a retirement question. What's going to make you get out of bed in the morning? Because if there isn't a reason, then why are you alive? So a lot of people struggle with that, is once you get to be wealthy, some people take it in one extreme and they say, all right, I want more wealth, because for them, it's more of a scorecard and it's a way for them to keep themselves in the game, because they enjoy that rush. They enjoy the competition. So they just keep growing to more. And that's fine. That's one way to address it. Another way is to certainly kind of discover what's important to you, find your passion, right? And go that way. But when it comes to investments, it's hard because there's the family office aspect, which is really about building multi-generational wealth. It's about building wealth that never expires, that will last, for all intents and purposes, forever, right? It's like a college endowment. College endowments, I'm literally disgusted by the amount of money some of these schools have, and they're also some of the schools with the highest tuition rates. We're talking about forgiving student loans, which is, I know, a rabbit hole, but these institutions have built wealth over decades. And this wealth is like $50+ billion in endowment for college that they don't need. I mean, they could buy the 5 towns around them if they wanted to. There's no need for that kind of wealth, but they do it. And, if you think about your own self, let's say you build $100 million fortune, what are you going to do with that? Are you going to keep it alive for your kids? How are you going to do that? Because it's like we talked about the 3-dimensional chess earlier. It's not just about investing well. It's about investing well. And what are your kids and your kids' kids and your kids' kids' kids going to do? If you own real estate, great. Okay. So they never sell it. Then what? What if things change? Demographics change? What if there's better opportunity elsewhere? Like, it gets into this question of, the questions center less about wealth at that level and more about the family. How are you going to raise money smart kids that aren't spoiled?
Mm-hmm.
How are you going to make sure they're productive citizens? How are you going to involve them in the money? Because a lot of people, I grew up around kids who were from wealth, and some of them end up being degenerates because they never had to work hard. Everything was given to them. And it's nobody's fault. It's just, when you're raised, you think about it, human beings were meant to work, to do labor. Like we need a focus, we need a purpose. Like all of us need a purpose. And maybe that's curating art, maybe it's, cleaning the trash, maybe it's, creating a tech company. It doesn't matter what your purpose is, but there needs to be a reason for being. And drinking margaritas and golf may be fun, but that's not a purpose. Yeah. And I think what happens is when that's removed, when people don't have that, then they flounder and they find it hard to find themselves. And then they do stupid things because they're depressed. And I don't want to get into all the trials and tribulations of the extra wealthy, but those are issues that they talk about. Those are issues that come into play because the wealth itself, once you reach, I'd say 10 million, it's not about making it, it's about keeping it. There's a big shift that happens. Making money is a very different investor mindset than keeping it. If you're worth $100 million, you don't care. You don't need 10%. You need to keep it. How are you going to keep it? How are you going to maintain it against inflation? How are you going to make sure that your grandkids don't fritter it away? Like these are all important questions. So they're very different questions than somebody who's trying to grind out a living and make $1 million so we can retire. You don't care about generational wealth. You care about having enough so you could retire. But once you reach that other echelon, it's very different. The conversations change. And the IRS, you don't get a letter that says, hey, you're rich, maybe from the IRS. But other than that, you don't get a letter. So there's no like definitive point where it's like, oh, I'm rich. But for some people, once you kind of reach that point, you start to feel like, I don't really know what's going on. Like, what should I do?
Yeah.
And it's a big psychological shift. And, I think it's just something that people need to be mindful, but I think when it comes to investing, the strategies change more towards preservation. They're more focused on being, I don't want to say tax avoidance, but tax management strategies. Yeah. And so for them, like, it's like, how do I pay the fewest amount of taxes and how do I keep my money? That's a big part of it.
Kirk, man, thank you so much for elaborating on that. I asked the question to a lot of guests, and a lot of times it comes down to, at this level, the 500 to 2 million, the similarities that I hear is they're trying to create that wealth. They go to work, they get a W-2, likely they have some kind of education that they've transitioned to the work, the daily grind, so they can make as much money as possible, save it, have that $500 to $2 million amount, and then retire at the end of their life. So that's a similarity that I hear multiple times. And I think the other part is that $2 million and up, a similarity that I hear is their investments get more complex. They're likely doing more than their 401k. They're investing in other vehicles. And then the $20 million and up, the family office, bringing in expertise and those types of things are kind of definitely what I hear to, advise on trusts, your legacy creation, putting in certain guidelines for that thing to keep going. But what I would think is new to this conversation is the mindset, right? Is, man, if you're at $100 million and they say, oh, that eagles fly alone, right? Or that individual that's different than others, it's like, well, who am I going to share that loss? Oh, I lost this, or I'm trying to make this move, or the pain of not knowing if my friends really like me for me, or because it's money, because it's like, who else can relate? There are less of them in that mindset. And then also the purpose, right? Where there's no vision, people perish. Man, when there's no purpose, it's like, why am I working so hard? Or either to educate myself, stay healthy, stay wealthy, stay, the grind that I think people have is definitely a push towards, bettering themselves. Right. So I thank you very much for that insight. I think is amazing. And I know, so we only have a few minutes left. So let me do one thing. Make sure to tell our audience, our listeners, who do you want to reach out to, Kirk? And where should they go? Who do you want to reach out to, and where should they go to contact you?
Yeah. So I would say, if you like what you heard today and you think that, if you're looking for advice and you think I'm somebody that kind of like fits what you're looking for, you can find me at innovativewealth.com. On our website, we have all sorts of resources, where specialty is alternatives like real estate held in IRAs. That's something we're well known for. So if you're interested, you can check us out there. Also, even if you don't like anything I said, or you don't like my voice, well, hopefully you like my voice, but you don't like the way I look, you can go to Money Tree Investing Podcast, and we talk about all sorts of, investing and personal finance topics every week. And, that's free. So, I'm not looking for business. If it's a good fit, it's a good fit. But for us, it has to be a good fit for us as much as it has to be a good fit for you. So yeah, you can find me if you're interested. Check it out, and let me know if you have any questions.
Right on. Thanks, Kirk. So for the conversation we've had the last couple of minutes, is there anything I didn't ask? Anything you were really excited to share about? I just didn't get to, or anything you wanted to bring up? And I'll give you the last few minutes, man. If there's any wisdom of nuggets of wisdom, or any other insights that we should have, man, I'll turn it over to you.
Wow, you're giving me the open floor. I think that's going to be tough. I could talk for hours on just about anything. No, I mean, honestly, Abel, I appreciate you bringing me on the show. I think this was a lot of fun for me, and I know you do a good job as a host. So, like I said, I could talk about just about anything, but I think we covered a lot in this podcast, and I think it'll be a good nugget of wisdom for your listeners who are looking to invest in real estate and other alternatives. That there are many ways to do it, and just do your homework, do your due diligence, and I think as long as you do that and spend. Let me give you a final. I got a good one. Most people, when they're looking at their investments, they look at performance first, and everybody does this. So don't feel bad about it. And the professionals do this. They look and they say, "What kind of performance can I get? Oh, I can get 12%. I'll take that." We don't do that because, frankly, you can't predict performance, right? You talked about cash flow earlier. You can predict cash flow. You can't predict appreciation. So when we're looking at real estate, we don't look at appreciation. I don't care about appreciation because that's a bonus. I don't know if it's going to go up or down. What do I know? I can't predict the future, but I can predict cash flow. So if something cash flows, I can say, "Oh, it's producing 6% cash flow. I love it. Let's do it." Right? So what I would say for investors is do your due diligence first. Do your risk management first. That's our philosophy, is risk management first. So do your risk management first. And if that passes muster, then you look at performance, right? Because everyone's going to show you, "Oh, I can make 30% a year," or whatever it is. But if you lose all your money because, the money wasn't set up right, or it was poorly invested or whatever, what does your performance matter, right? So do your risk management first. And this applies to every investment. So I know we're talking about real estate. It applies to every investment. Do your due diligence first. If it still looks good, then you look at the performance. So that's the way you should do it. Almost everybody does it the reverse. And that's why people get surprised when they lose money, because they're like, "Wait a minute, I thought I was going to get 30% a year." So if you do your research and you do diligence first, I think you'll be surprised a lot less.
Yeah, buddy. Thank you very much. I appreciate the insight and wisdom, and I wholeheartedly agree. I think everything that Kirk mentioned on due diligence, risk management, mindset, psychology, how to move forward. I just, it's a very good look to be, to have a winning psychology to make sure we're making as much as we possibly can without losing as much as or anything really. So, anyways, man, Kirk, I really appreciate your time. Thank you very much for gracing us with your presence. Hopefully, somebody reaches out to you as well, gets into your world, and for our listeners, go reach out to him, his podcast, vice versa. Give us the review, the like. Let us know what is good and bad. We'll take the feedback and we'll try to improve every show. So, thank you very much. My name is Abel Pacheco. They're the hosts of the Five Talents podcast, How to Build Wealth Like the 1%. I appreciate it. See you later, Kirk.